Good morning, students. I am going to start lesson 3, module 2. Module 2, lesson 3. The name of the lesson is investment function. Investment function. In this investment function, we have to discuss meaning of investment, then determinants of investment, marginal efficiency of capital, MEC schedule and MEC curve, then determination of equilibrium level of interest by MEC rate of interest and factors affecting MEC. This is very important topic, so all of you should listen to me very carefully. So first of all, understand the meaning of investment. In ordinary language, investment refers to the purchases of financial assets such as shares, bonds, etc. But economists restrict the use of the term investment to the creation of real assets which add to the total stock of physical capital. Investments can be made by households in the form of residential construction, by business firms in the form of plant and equipment, and by the government in the form of construction and plant and equipment. So investment can be made by households, firms and government also. So let us understand the concept gross and net investment. Investment may be either gross or net investment. If we deduct from gross investment expenditure and allowances for the amount of the existing plant and equipment used up in the producing the period's output, we have the net investment. In other words, net investment is the gross investment minus the replacement investment. Gross investment is the total amount spent on new capital assets in a period. And replacement investment refers to the expenditure incurred to maintain the total stock of capital in the economy. That is the expenditure undertaken to offset the depreciation, wear and tear and obsolescence in the existing productive capacity. So net investment is equal to gross investment minus replacement investment. Next type of investment, real and financial investment. In Keynes economics, investment means real investment, which refers to the addition to the stock of the physical capital. It does not include the purchase of existing stock, shares, securities, which merely represent a change in the ownership of the assets that already exist. Such an investment is called a financial investment which does not affect the aggregate demand. But real investment increases the aggregate demand and brings about an increase in income and employment in the economy. Next type of investment, autonomous and induced investment. Autonomous investment doesn't change with the change in the income. It generally takes place in houses, roads, public buildings and other parts of infrastructure. Autonomous investment depends more on population growth and technical progress and then the level of income also. But induced investment is that investment which changes with the change in income and it increases with the increase in income. Now, determinants of investment. Investment is determined principally by the marginal efficiency of capital and rate of interest. So this is important. Understand marginal efficiency of capital. The marginal efficiency of capital is ordinarily called expected rate of profit. The prospective investors will keep on comparing the marginal efficiency of capital with the rate of interest. If the investment is to be profitable, the expected rate of profit must not be less than the current rate of interest in the market. If the expected rate of profit is greater than the rate of interest, there will be new investment. And conversely, there will be no investment if the rate of interest is higher than the marginal efficiency of capital. The changes in the marginal efficiency of capital cause changes in investment, which in turn fluctuates aggregate demand. Now we will discuss about marginal efficiency of capital. See, basically in ordinary language, what we discussed already, marginal efficiency of capital is called as expected rate of profit. So understand this. Marginal efficiency of capital refers to the expected rate of profit from an investment in a new capital asset. The marginal efficiency of capital depends upon two factors. Number one, the expected rate of return or the prospective yields of the capital assets over its lifetime. And second, the supply price or the replacement of the capital assets. The prospective yields refer to the total net return expected from capital asset over its lifetime. The supply price of the capital asset refers to the cost of new assets, which is called as replacement cost. According to Keynes, marginal efficiency of capital is the rate of discount which would make the present value of the prospective yields from capital assets equal to its supply price. Now next point we will discuss what is marginal efficiency capital schedule and MEC curve. The marginal efficiencies of all types of capital assets which may be made during a given period of time represent the schedule of MEC. A hypothetical MEC schedule is given in the table. Here it is a table. It shows that as investment increases in a particular capital asset, MEC goes on falling. In this table, investment is rising from 25,000 to 50, then 75,000 and 1 lakh, but marginal efficiency of capital is falling from 15 to 12, 10 and 8. These are the hypothetical, we can say that these are the hypothetical figures we have given here. Then the explanation of the diagram. In this first diagram, along with x-axis we measured volume of investment, along with y-axis MEC, that is marginal efficiency of capital. The MEC curve slopes downward. It is sloping downward. It shows that there is an inverse relationship between investment and MEC. That is, as investment increases, MEC falls. As investment increases, MEC falls. There is an inverse relation. In the second diagram, the shifts in MEC curve, this shifts from MEC to MEC1. That curve is shifting from MEC to MEC1. The shift in the MEC curve is caused by the changes in profit expectations, which are the result of dynamic forces of growth and technology. So according to Keynes, fluctuations in investments are basically caused by changes in expectations and shifts in MEC rather than in the rate of interest. So what, according to Keynes, these fluctuations, that means from MEC to MEC1, the investment is rising, that is caused by the changes in expectations and shifts in the MEC rather than the changes in the rate of interest. This is, you have to write about MEC schedule and MEC curve. Let us move on to the next point. Determination of equilibrium level of interest by MEC and rate of interest. Determination of equilibrium level of interest by MEC and rate of interest. So the volume of investment is determined by MEC and rate of interest. As long as MEC is higher than rate of interest, investment will be continued to be made. The equilibrium level of investment will be established at the point where MEC becomes equal to the current rate of interest. Now in the first diagram, here in the first diagram, this is the first diagram, if the rate of interest is I1, the investment will be OM1. Look at the diagram. If the rate of interest is I1, the investment will be OM1. Okay. And because at OM level the investment MEC will be equal to I1. That is the rate of interest. If the rate of interest falls to I2, the investment will rise to OM2. When the profit expectations changes, the MEC curve is shifting in the second diagram. As I told you in the last diagram also, in the last page, that MEC curve is shifting. Like that here also, when the MEC curve is shifting, that in the increase in the profit expectations will shift the MEC curve to MEC1. See, from here MEC to MEC1, and therefore at I rate of interest, the rate of interest is same. The investment is rising from I1 to I2. So this is what you have to write about the determination of equilibrium of interest by MEC and rate of interest. Now in the next point, we will discuss what are the factors affecting MEC. We can classify the factors MEC into two types, short run and long run factors. The important factors which influence MEC in the short run are expectations about demand, price and cost. The MEC will rise if the investors expects the demand for the product to rise or price to rise or cost to fall, and vice versa. Second, changes in propensity to consume. An increase in propensity to consume will raise MEC and vice versa. Next, changes in income. Sudden increase in income will raise MEC and fall in income will lower the MEC. Business optimism and pessimism. Business optimism will increase the MEC and business pessimism will lower the MEC. In the long run, the important factors which will have a favorable effect on MEC are increase in population, development of new areas, improvement in technology and development in infrastructure. So these are the factors, they affect the MEC in the long run, that is marginal efficiency of capital. So in this way, this factor will lead to huge investment activities of all types in the economy. This is what you have to write about this investment function. Students, the question can be explain the marginal efficiency of capital. So here what you have to do, first you have to give the meaning of investment, then determinants of investment, marginal efficiency of capital schedule, MEC curve. These are really very simple. Just you have to draw that downward sloping demand, like how we are drawing in the demand curve, downward sloping MEC curve, then shifting of MEC curve, and the same thing you have to show here also. And the last point is factors affecting MEC. The question can be explain or what is the meaning of investment, and explain the factors which determine MEC, or explain the concept MEC, and what are the factors which affect MEC in the short run and long run. So entire topic you can cover in that answer. Thank you very much.